Hello everyone, welcome to today's lecture. So today we are going to cover rest of the part of this audit committee and LODR regulations. Then we'll move to the consolidated financial statement. So till last lecture, what we saw is that what are the regulations of LODR which are applicable with respect to audit point of view and the compliance verification point of view. So remember we talked about a certificate on compliance of corporate governance. So we were seeing some regulations which were also applicable for we saw the comparison between the Companies Act and the SEBI LODR regulations in terms of the corporate governance. We understood what are the, you can say, definition of corporate governance, what are the key things of the corporate governance. So we discussed a lot in the last lecture with respect to the corporate governance, LODR regulations, and Companies Act with respect to that. Now, moving ahead with on the same path. Okay, so last we discussed remuneration of directors. Okay, and its disclosure requirement, which was part C of Schedule 5 of the regulations, not of the Act. Okay, now the next thing is approval of the directors' remuneration. Now there is a regulation 17.6. Okay. So there is a regulation 17.6, which talks about approval of directors' remuneration. Now, what they say that all fees which are paid to non-executive directors, including independent directors, shall be recommended by the BOD itself to the shareholders in the general meeting, and then they should be approved by shareholders in the general meeting. That's the thing. Shareholders can also specify the maximum limit of which the options can be given to the directors, non-executive directors in a financial year. That also is there. Okay. However, there is one condition that I want to specify is okay. Approval of director remuneration, it's the regulation 17.6. Okay. Now there is one condition under this is that a special resolution is required if annual remuneration payable to a single non-executive director. So annual remuneration payable to single non-executive director exceeds 50% of the total remuneration that is payable to all the non-executive directors. Total 50% of the total remuneration payable to all the non-executive directors. If this is the condition, if your annual remuneration payable to the single non-executive director exceed of 50% of total remuneration payable to non-executive director, then you require a special resolution for this, for approval of your remuneration. You require special resolution, and that is to the every year. You will be requiring special resolution every year. Okay. However, this approval, prior approval of shareholders in general meeting is not applicable in case of payment of setting fees. So this whole is not applicable to payment of sitting fees to non-executive director. That is out of the scope. Okay, that is out of the scope of this particular regulation. So it says that it is not applicable in case it's a payment of sitting fees to non-executive director if made within the limit of Companies Act. Within limits of Companies Act. Okay. Now, compensation that is payable to the executive directors. We were talking about now non-executive directors. Now executive directors. Okay. So the fees or compensation payable to the executive directors, who can be either a promoter or a member of promoter group, or you know, a relative of a promoter group, if the annual remuneration payable to executive director exceeds 5 crore or 2.5% of the net profit of the listed entity, then in that case a special resolution will be required for that particular remuneration. A special resolution will be required. Or if when there is more than one executive director, okay, when there is more than one executive director, then in that case, if the aggregate remuneration payable to such executive directors exceed 5%, then in that case a special resolution will be required. Okay, so remuneration payable to executive director who is also a promoter or part of a promoter group. So executive director plus he should be promoter or member of promoter group. Okay, if the remuneration payable to the executive director who is a promoter or member of promoter group exceeds 2.5 exceeds 5 crore rupees, 5 crore, or 2.5% of net profit, then you require a special resolution. Or again, remuneration payable to one or more executive director. Again, the condition will be same. They should be promoter or part or member of promoter group. Okay, exceed 5% of net profits. Then for whole of this transaction, in both cases you will require special resolution by shareholders. Now understand why this thing is there. This thing is there to bring and to implement a check on the amount of remuneration payable to the related parties. So if, let's say, for example, today promoter is there, promoter is the director. Okay, so to keep a check that how much amount is paid to the switch promoter director, you know, and how much amount is paid to the rest of the directors. This sort of check or this sort of information should be approved by shareholders in the general meeting. That's why this particular regulation for the listed companies has been brought, that in case the director is the promoter and if these limits exceed for the remuneration, then they require a special approval, special resolution by shareholders. Any doubt till now? Any doubt? Guys, you may think that, okay, this is a bit of theory one, but the thing is, if you understand the logic behind why this section was brought, you will be able to remember this very easily. Another thing is, don't try to just learn the mug up the things, understand the things, then you try to remember it. It will be very easy for you to understand the concept and the topic, rather than just plain mug up or learning the sections. Okay. any doubt? Good. Okay. Thank you, Srinidhi. Thank you, Mahendra. Now, we saw the remuneration of the board. We saw the composition. This was the approval of directors' remuneration. This was the remuneration of director disclosure requirement. Now, this is number of directorship. We also saw the composition of board over here. So we were talking about board of directors, their composition and their remuneration. Now it's time to understand their meeting requirements. Okay. What are the meeting requirements of board? So as per regulation, there are various regulations from 17 to 26, 17 to 74, 17A, 25, 26. So as per these various regulations, BOD, meeting requirement. So as per the regulations, there are various regulations. As per the regulations, BOD shall meet at least 4 times in a year. Okay. Shall meet at least 4 times in a year, plus the gap between 2 meetings should not be more than 120 days. Gap between 2 meetings should not be more than 120 days. Now, the reason for this particular provision is very simple. Let's say tomorrow, if I say, okay, let's conduct the BOD meetings. Okay, let's conduct the BOD meetings. Now, I'll tell you, for example, let's say date of BOD meetings. 27, 3, 2022, 28, 29, 30. So these were the 4 dates of BOD meetings. Now, if I conduct all the meetings, let's say on 28, 29, 27, 28, 29, 30, the criteria is met. 4 board meetings in a year. 4 I have done. Then it will become just a formality. Why board meetings are required? For the efficient management of the company, efficient operation, for maintaining the efficiency in the operations of the company. Now, if I conduct all the meeting, let's say in the last 4 days of the year or somewhere in the between, but consecutively 4 days, it will not give me any of the, you can say, operational efficiency or, appropriate management of the company. This will be a tick in a box formality. That's why, to ensure that, this shouldn't be a tick in a box formality, they brought a regulation that, okay, at least 4 times a year, fine. But there should not be more than 120 days gap between two meetings. 120 days will be near to your 4 months. So at least there should not be more than 120 days gap between your meetings. This will ensure, okay, there should not be 4 months gap at least, and this will ensure your operational efficiency or appropriate management of the company. Now, this was the meeting requirements with respect to the time. What should be the quorum of these meetings? So quorum is as per the regulations, it should be 1/3 of the total strength. 1/3 of total strength. Okay, or 3 directors. Whichever is higher, and plus 1 independent director. Okay, so it should be 1/3 of the total strength or 3 directors, and out of these this requirement, one should be independent director. Clear? So that's the requirement of quorum of BOD meeting. They can conduct, by virtual meeting through video calls and video conferencing. That is fine. Now, when I say these requirements are this board of BOD meeting requirements, quorum of BOD. These are applicable to top 2,000 entities. Applicable to top 2,000 entities. Now, what is top 2,000? Top 2,000 based on my market capitalization. So, based on your market capitalization, you can decide, okay, which are your top 2,000 entities, and to these entities, these regulations are applicable. Okay. Now, we discussed the number of directorship. We discussed the director should not be, in number of directorship over here for the listed entities. Okay. Whole-time director, managing director should not be more than 3 directorship, independent director 7, and others also 7. That's the requirement. Okay, for the number of directorship for listed entities. Now, there is also a limit on the number of membership in a committee. So remember, this was the number of directorship. Now we are talking about number of members, membership in committee. Ceiling on membership of committee. Now, what are these committees? Audit committee, let's say XYZ committee, this committee, that committee within a company. When I was talking about number of directorship, it was between multiple companies. Now I'm talking about ceiling on number of membership of committees within the company itself. Okay. So a director shall not be more than director shall not be a member in more than 10 committees. More than 10 committees, or act as a chairman of more than 5 committees of listed entities. So in total, if he is a director, then he cannot be more than member of more than 10 committees, or act as a chairperson of more than 5 committees across all the listed entities. So director member of not more than, let me write in this way. Okay. Maximum membership of committee in case of a director, it is 10 committees. Across all the listed entities. Now this will be counted as across all the listed entities. Okay. Now, second thing is, I was talking about maximum number of membership of committee. Then the second point comes is, I'll remove this. Maximum number of chairperson. Okay. Chairpersonship, or maximum number of chairpersonship, or you can say maximum number of maximum number a director can be a chairperson. Okay, in that case of committee, director, so he can be in how he can be only and only 5 committees. He can be chairperson of only and only 5 committees. Again, this is also across all the listed entities. Across all the listed entities, you need to count this number. That maximum number of membership of committee 10, and maximum number of chairpersonship of committee 5. Okay, now this will include this will include my all listed entities, public limited entities, but foreign companies, high value debt listed entities, and companies under section 8 of the Companies Act are excluded. So what I need to exclude is over here. Private limited companies, foreign companies, then high value debt listed entities, high value debt listed entities, and then section 8 companies. Now high value debt listed entities, this particular item, is a recently added item. You can say this is a part of our amendment that has been included over here. Okay, so high value debt listed entities were not there as a part of this list, which were excluded from the number of directorship or chairpersonship for a company or for a director, but now it has been excluded. So if a company is classified as a high value debt listed entities, then they are not for those entities are not required to be counted. They shall be excluded. So you can say all other companies other than the listed entities are excluded here. Now you may ask whether the audit committee, stakeholder relationship committee, risk management committee, is there any exclusion on the part of the committees? Answer is no. All committees are included. Okay. Any questions on this? Jay, remuneration to directors not part of promoter group. It will be governed by Companies Act then. There is no separate provision or regulation given in your SEBI LODR. Jay, can you talk FST? What do you mean by FST over here? Jay, it's usually financial year unless and otherwise it's mentioned for a calendar year. So if it says a year, then it will be a financial year. No, it says that consecutive meetings are allowed, but there should not be gap of more than 120 days between two meetings. So if you conduct a consecutive meeting, let's say for example, they are saying at least 4 times in a year. What if I conduct 10 times and two meetings or three meetings together? It is fine. It is perfectly fine, Jay. Uh, Good question. Who publishes market capitalization data? So, Jay, market capitalization data can be easily obtained from your stock exchange. Can senior, good question again. Can senior employees, not director like CA, not director like CACS, be part of audit committee? They are, but again, that will depend upon what will be the scenario, what are the case to. It will totally depend upon case to case, company to company. However, if you see on the regulations provide what should be the minimum what you say criteria for the audit committee. Like if the audit committee consists of directors, then what? And still in the audit committee they can choose a representative for the technical and all those matters. That is fine. But again, that depends upon company to company, how the hierarchy in the company is decided and how it is managed, and accordingly like that. And say for example, if you say senior management, a senior employee, then who are senior employees, which on which position, like this way. Okay, yeah. So sure, Jay, sure, Sainam. So you both have a same question. What is a debt high value debt listed entity? Okay. Uh, Now, if you see there is a provision given or there is a detail given that what is a high value debt listed entity. So they have explained in detail in the regulations that okay, these are there is no one single condition, but there are multiple conditions for this particular scenario. So if you want to understand, we need to go, you need to go and you need to see the details of that particular regulation for this particular definition. So just to give you a brief, background about this, just hold with me 1 minute. Okay. So I can provide you the particular notification where you can search this particular detail and regulation in detail, and you can then okay. So generally, how just to give a background, how it goes, like when I say high value debt listed entity, okay, they have a limit of 500 CR on the stock exchange. Okay, what on the based on their LODR regulations, the debt should be non-convertible. It should be of 500 crore or more, and there are other terms and conditions also to to classify them as a high value debt listed entity. But if you want exactly, then you can see LODR regulations chapter 5. Okay, chapter 4 and chapter 5, where this amendment has been brought and where this has been included. Okay, what is a high value debt listed entity? But to summarize, you can say non-convertible debt listed on a stock exchange of more than 500 CR of amount. See, Jay, there is no simple question, simple answer to this particular question. So your question is non-compliance with LODR regulations. Then what actions auditor need to take? That will depend upon the materiality of the impact. Okay, what is the impact due to non-compliance? What is the for example, let's say there is a one crucial provision of LODR. If I non-comply with that provision, my stock can get delisted. So let's say, for example, there was some quarterly reporting. For now, since 4 quarters, I have not performed the quarterly reporting. So there are chances that my stock can get delisted. You need to assess the impact of the non-compliance from case to case basis. Okay, what is the impact on my financial statement? What is the impact, monetary terms, non-monetary terms, from the goodwill side, everything, each and every impact you need to assess, or management needs to assess, and then you need to verify whether the assessment done by the management is appropriate or not. So auditor needs to first verify the assessment done by the management with respect to this. Number two, if you feel the impact is material, then whether see that okay, that has been appropriately disclosed in the financial statement by the management. If not, then you can think okay, whether it will impact the decision making of the users. If yes, you can consider there's a material. Now you need to decide whether you need to modify your audit report, or you can issue an adverse opinion. That again will depend upon the level of impact. So it will be on case to case basis. So Now, one of the question is, can director be part of audit committee plus board of directors? Answer is yes. Actually, if you see, audit committee are primarily made of directors only. So a director can be a part of audit committee. He will be a part of audit committee and board of directors. Any further doubt, guys? Any further doubt? Any further? I'm happy to see that there are so many doubts. Good. Okay. If no further doubts, then we can move ahead. Okay. Now, remember we talked about SA 250 in start that we need to see compliance with the SA 250 also with respect to the non-compliance. So you need to also assess what is the impact of non-compliance of laws and regulations from SA 250 side also. Okay. Now, this was the composition of board. This was the, you can say, composition of audit committee, details of audit committee, how the audit committee should work, how the board of directors should work, what should be the remuneration and all those stuff from their side. Now, what we are going to see is a code of conduct. Remember, we were talking, the whole topic revolves around the corporate governance. The SEBI LODR regulations are also talking about the corporate governance. As of now, for this particular chapter, we are talking about corporate governance. So when auditor certifies on the conditions of the corporate governance, whether there has been compliance on the conditions of corporate governance or not, in that case, what he needs to see is actually the conditions, and one of such condition is a code of conduct. Okay, so SEBI LODR regulations say that this will not work. This composition, this only this composition, only remuneration, this will not work. So along with this, you need to have a code of conduct. Now, what is a code of conduct? Now, code of conduct, you can say a defined way of working. Okay, define the way of working, meeting, how the things should flow, rules and regulations, everything. So it is said as per the regulation, okay, and schedule 5. As per the regulations, these are the regulations which I am going to talk about now. Okay, as per the regulations, what is required in the code of conduct is rules, regulations, then the way meetings are conducted, business are discussed, all those things should be there in the code of conduct. So first of all, for that, board should lay down a code. It is the responsibility of board to lay down a code of conduct. Okay, once board lays down a code of conduct, all board members should comply with it. That is fine. Number 3, annual report of the company shall also contain a declaration. Annual report of a company shall also contain a declaration to this effect. Means I have done I have conducted board has drafted a code of conduct. Now directors will affirm their compliance to code of conduct. Now this affirmation will be published in annual report. Okay, this affirmation will be published in annual report as a declaration by CEO. Okay. So now CEO will sign and say that, okay, all the directors have submitted their affirmation with compliance to the code of conduct, and that declaration will be signed by CEO. Code of conduct is, when a code of conduct is drafted, it should be in line with your company's act. It should specify what are the duties of independent directors, what are the duties of all the category of directors. Okay, how the business should be done, what is the way that uh, the director should meet, discuss, and all those stuff. Okay, along with this code of conduct is also required to be posted on website. Okay, so code of conduct is also required to be posted on company's website. Clear? So that was for the code of conduct. Then comes the important topic. Somewhere above, we discussed about one of the things. I'll tell you. When I started this topic, I was talking about corporate governance. Okay, corporate governance had code of conduct, vigil mechanism, compliance certificate, disclosure, committees, responsibilities, management of subsidiary, risk management, related party, and compliance certificate. So code of conduct we saw. Now why we are discussing all these topics? In the start also I said you that this is a part of corporate governance. This is a part of corporate governance. To have a appropriate corporate governance within an organization, I've already done, sorry. To have a appropriate corporate governance within an organization, you should have these things appropriately defined. Which are these things? Code of conduct, vigil mechanism, details of compliance certificate, disclosures, committees, like drafting, appropriate composition of audit committee, remuneration of audit committee, meetings, responsibility and key function of boards, board composition, boards remuneration, management of subsidiary company, risk management. So all these things are required. Out of this, we saw this particular area. We saw disclosures. Remember disclosure regarding directors' remuneration. Audit. We saw audit committee. We saw responsibility and functions of board. Now we'll be talking about this particular vigil mechanism. Okay. Now, vigil mechanism is governed basically by Regulation 2246 and Part C of Schedule Y. Okay. Now, what are the requirements of SEBI LODR with respect to the vigil mechanism? As per the regulations, it is said that the listed entity shall establish a vigil mechanism. Okay. So, listed entity establish a vigil mechanism. Till now, this was defined. But now there has been an addition to this. Now it is said that along with vigil mechanism, instead of vigil mechanism, or you can say I shall establish a vigil mechanism or a whistleblower policy. A whistleblower policy for employees and directors to report their concerns. Okay, so this whistleblower policy is an amendment. Earlier, till now, it was only about the vigil mechanism, but now it has they have included the word whistleblower policy also. Okay, so every listed company shall have this vigil mechanism and whistleblower policy. The mechanism should also provide adequate safeguards from victimization of directors and employees or any other person. Okay, so not only establish a vigil mechanism, but provide safeguard, against victimization. What is victimization? Victimization means today if you reported something, now tomorrow I know you reported against me. I'll go and I'll try to harass you. I'll try to create problems for you in the company, and then what I'll do is I'll make sure that you are fired out of the company because of XYZ reason. So retaliation. I'll take my personal grudge upon you because you reported something against me. So that is something providing safeguard against victimization, so that no one can be harassed, or no one can be like in case, let's say for example, if today if I'm reporting against my manager because he's doing something wrong, and tomorrow if my manager tries to uh, hamper my progress, my career growth, or he tries to get me fired, then there should be a safeguard for me. Otherwise, who will report? Otherwise, who will report? Who will take a risk? Okay. Now, vigil mechanism, whistleblower policy, safeguard details, all these should be available on company's website. Okay, this should be also available on the company's website, and shall also be available on available in the board report. Okay. I hope I'm clear. Any doubt? Correct, Sairam. Victimization is also misusing the power. What is vigil mechanism? Vigil mechanism is just monitoring, or you can say a mechanism created to monitor any I can say activity which is not good or non-ethical. Okay, so for example, let's say some fraud is happening in the company, so there should be appropriate mechanism present, okay, by which the company can see, okay, what is going on. Can someone report this fraud? If let's say for example, if not applicable to, let's say I'm a board of director, I may not be involved in each day-to-day transaction, but there are people who are involved, and from that if someone identifies, okay, what is it, something wrong is going on, how they can report, that is a part of a vigil mechanism. So that was a particular, it can be for malpractice, misuse, fraud, violation of company rules, manipulation in operations, then misappropriation of assets. Okay, that's a basically a mechanism formed to report these things, or to to identify these things when it is reported by some of the, let's say, employee of the company or director of the company. Any doubt? Any doubt, guys? See, with respect to the vigil mechanism, so there is not only the responsibility of the audit committee, but it's the responsibility of board of directors also. Usually, most of the policies are formed by board of directors, but on the recommendation of the audit committee. In the same way, over here also, uh, vigil vigil mechanism, or you can say whistleblower policy, are not only the responsibility of the board of directors, but sorry, not on the responsibility of the audit committee, but also responsibility of the board of directors, because board of directors are the primarily responsible for the management of the company. Okay, any further doubt, guys? Yes, this is applicable. See, we discussed, this is applicable to, I'll show you. So we were discussing about the SEBI LODR regulations, which is applicable to the listed entities. Okay. Now, if you see section 177 of the Companies Act, section 177 of the Companies Act, in that there is a section, subsection 10, which talks about subsection 9 and subsection 10, that every listed company or classes of company shall establish a vigil mechanism for directors and employees to report genuine concerns in the such manner as may be prescribed. Okay. So from there, it is also applicable to the classes of the company which is being prescribed by the central government, where the vigil mechanism is required to be, is a mandatory part. Now, if I have to just a minute. When I say classes of company, okay, they in that company, which like companies which are listed, which accept deposit from public, company which had borrowed money from banks or financial institutions exceeding 50 crores. So there are requirements given, and there is a rule 7, establishment of vigil mechanism. Okay, you can refer to that particular rule, and the manner in which it is required to be formed is again that rule 7. You need to refer that rule 7 of the Companies Act, where it has been talked about establishment of vigil mechanism. If I have to give you the exact name of the rule, Okay. So it's a rule 7 and section 177 subsection 9 subsection 10 and rule 7 of companies meeting of board and its power rules 2014. So companies meeting of board and its power rules 2014, which talks about establishment of a vigil mechanism. I'll also write it down for your reference over here. Section 177 subsection 9 and 10. Okay, these sections talk about establishment of vigil mechanism plus you need to see rule 7 of companies meetings of board and its power rules 2014. Okay, so these are the two things you need to refer for the vigil mechanism provided under the Companies Act. Now, as per the Companies Act, in case of the listed entity, okay, or in the case where the there is an audit committee present. Now, the companies which are required to constitute an audit committee shall oversee vigil mechanism through a committee. Means there should be another committee which should be responsible for the vigil mechanism. This is as per the Companies Act. So, as per Companies Act, if audit committee is present, okay, if audit committee is present in that particular company, means the company is required to constitute an audit committee, then this audit committee shall oversee. Audit committee shall oversee vigil mechanism through constitution of another committee. Means by constituting another committee, like say vigil mechanism committee or whistleblower committee, like this way. Okay. Now, in case when the company is not required to have audit committee, if company is not having audit committee, then board of directors shall nominate a director who will play a role of audit committee. Means board of directors shall nominate a director to act as audit committee. Okay, now that director will work like same way, like in the case of audit committee is required to oversee the process. Okay, so now this director will oversee the vigil mechanism through other committee if it is required to be formed. Now, again, vigil mechanism should provide adequate safeguards, that is there. Okay, in case of any complaint being reported by the employee or any of the director, then the audit committee or the director nominated shall play the role of play the role to take suitable actions against the concerned director or employee. Means when a complaint is being received, the audit committee or a director or any committee established by audit committee of such director shall investigate and identify whether any decisions or any thing is required to be done And if yes, then they have the right or the power to take those actions against such of the concerns raised. So that's something, vigil mechanism from the company check point of view. Vidula, can you repeat your question? I'm not able to understand. Direct access means? Okay, I understood. Okay. So, Vidula, good question. Why in the provision of the Companies Act it is mentioned that that vigil mechanism shall provide adequate safeguard plus a direct access to the chairperson of the audit committee or the director nominated as the audit committee in exceptional cases. Reason because it may happen that, for example, let's say they're talking about exceptional cases. One of the director who is a part of the audit committee is also involved in this particular issue. Then, if I report anything in the name of the director, let's say if I report anything in which a director of the audit committee is also involved, so the same thing will go to him and he will come to know, okay, something has been reported about me. And there are chances that he may, take actions or, he may harass the employee. That's why in the exceptional cases, the option should be available to go directly to the chairperson. Or in cases where you don't know, okay, which director is involved, it can be from an audit committee, it can be anyone else, but okay, someone from the top management is involved. In that case also, there should be an option directly to go to the chairperson of the audit committee to discuss these critical scenarios. I hope I'm clear. Any further doubt, guys? Thank you, Vedula. Any further doubt? No. So this was a particular about the vigil mechanism from the LODR side plus from the company sex side. Clear? Okay. Now the next topic for today. Just a minute. So the next topic we are going to discuss about is subsidiary, management of the subsidiary company. Remember, one of the point in the start we discussed, okay, was about management of the subsidiary company. Now, what is this? First of all, we need to understand which subsidiaries we are talking about. So we are talking about material subsidiaries over here, management of material subsidiaries. Now, a holding company is required to take some actions or perform some duties with respect to the material subsidiaries. So of listed entities. Again, multiple regulations in play. Plus your part C of Schedule 5. Okay. So regulation 16/2446 plus part C of Schedule 5. Now, what is the management is required in subsidiary companies? As a holding company have some is required to have some view or check on subsidiary companies as per the corporate governance regulation, means defined regulations. So as per the corporate governance also, let's say for example there is a holding company. Okay. Now, if it is a holding company or parent company, it has a duty towards its subsidiary company also, fully owned subsidiary or as the case may be, to look into some of the things, let's say critical things, which also affects the holding company. Now, it is not necessary that holding company should look into each and every subsidiary company. For example, I can have 100 subsidiary companies. Okay, let's say for example, when I prepare my consolidated financial statement, I consolidate 100 of subsidiaries. Now, before let's say consolidation, there might be subsidiaries whose income or the amount of for the consolidation will be higher, and there will be subsidiaries who will be immaterial. So now there comes a point. Okay, we are talking about materiality in case of subsidiary when we talk about review by the holding company. Reason because holding company cannot review each and every subsidiary. Otherwise, it will be like, you are reviewing the holding company also, you are viewing the holding company also, but you are also viewing the subsidiary company's affairs. So it may happen that, okay, so for example, I'll show you with one example. A Limited, B Limited, C Limited, D Limited, and here is ABC Limited. Now this is holding. These are subsidiaries. S1, S2, S3, S4. Each subsidiary has their own management. Each subsidiary has its own management also, plus ABC Limited's management. Okay. Now, this, let's say, constitute of 70% of total, let's say, of total income, total consolidated income. This constitute 10% of total consolidated income from a group point of view. This again consists of 10%, and this consists of let's say 5%, because I give 5% to this particular company. Okay, 5% of total consolidated income. Now, what I'm saying is ABC Limited's management should review certain things, not all things, should review certain things of A Limited. Reason because it have a material impact on the consolidated financial statement, plus it is a material subsidiary or important subsidiary for ABC Limited. Now, why I'm not talking about D Limited is because it has a lower share of total consolidated income, means it is not that much material compared to A Limited. And let's say if ABC Limited has to review each and every subsidiary, then what is the need of separate management for the subsidiary? They can have a common management of ABC holding and all the subsidiaries. So that's why the concept of material subsidiary. So A Limited will become my material subsidiary, comes into the picture. Like auditor, like in the case of audit, auditor cannot review each and every transaction. In the same way, management also cannot review each and every subsidiary and cannot keep an eye on each and every subsidiary. Hence, they need to think about think from the materiality point of view. So, as per the regulation, what is the material subsidiary? Material subsidiary is a subsidiary, okay, either, so there are two conditions, okay, either then net income, whose income or net worth, whose income or net worth exceeds 10% of consolidated income in case of income, and in case of net worth, your consolidated net worth. So if your income or net worth exceed 10% of the consolidated income or net worth of the listed entities and its subsidiaries in total, okay, then it will become a material subsidiary. Now for this you need to see these amount like income, net worth of immediately preceding accounting year. So income or net worth should be of immediately preceding accounting year. Clear? So that is the definition of the material subsidiary. Okay. Now we understood material subsidiary. What is a material subsidiary? Now what are the requirements from the side of management towards the material subsidiary? What management needs to do for the material subsidiary? So requirements of management, or you can say roles of management in material subsidiary. What is the role of management in case of material subsidiary? We understood which are the material subsidiary. Now what is the role? What management needs to do? So first of all, what management needs to do is, in case of a material subsidiary, at least one independent director of the board of directors of listed entity shall be director of unlisted material subsidiary. Okay, so one independent director of listed should be director in unlisted material subsidiary. Okay, independent director, at least it is at least one independent director of listed should be director in unlisted material subsidiary. Okay, now this was regulation 24(1). Okay, for this particular regulation, only for this particular regulation, okay, only here I'm talking about, only here the limit of 10% becomes 20%. In the limit of 10% become 20% in case of material subsidiary. So earlier we saw the definition of material subsidiary, that whose income or net worth exceeds 10% of the consolidated income or net worth. But only for this regulation, that is regulation 24, wherein one independent director of listed is required to be director of unlisted material subsidiary. Here we need to see the definition of material subsidiary as 20% of income or 20% of net worth. So 10% will become your 20%. Okay, only for this. Then another condition is audit committee of listed. Okay, audit committee of listed entities shall review the financial investment made, in particular the investment made by the unlisted subsidiary. Okay, so audit committee is required to review, what they are required to review is financial statement plus investment made by unlisted subsidiary. Unlisted subsidiary, okay, of unlisted subsidiary. So financial statement of unlisted subsidiary and investment made by unlisted subsidiary. Now remember, what is the word I am using? Unlisted subsidiary. I have not used the word material unlisted subsidiary, and that's the reason, because it's the provisions requirement. So here materiality is ignored, means audit committee of listed entity is required to review of each and every unlisted subsidiaries financial statement and investment they have made. This is without the concept of materiality, like 10% or 20%. Now I'll say in one of the clause you are saying that 10% should be 20%. In another clause you are saying that okay, we are required to ignore the whole materiality concept. Then why there is a requirement of 10%? Because in some of the provisions, a general definition of 10% is used. A reference to the general definition is used. Okay. Now, another requirement is, the minutes of board meeting of the unlisted subsidiary shall be placed at the board meeting of the listed entity. Okay. The management of unlisted subsidiary shall periodically bring to the notice of board of directors of the listed entity that a statement of the all significant transaction and arrangement entered by the unlisted subsidiary. So two things. Okay. Now, minutes of board meeting of unlisted subsidiary shall be placed at board meeting of listed entity. Okay, shall be placed at the board meetings of listed entity if anyone wants to see. Then second thing is that management of unlisted, okay, management of unlisted subsidiary shall submit a statement, or shall periodically bring to the notice of the board. You can say bring notice to management of listed entity. Now what they should bring to the notice? They should bring to the notice of the board a statement of significant transactions plus arrangements entered into by the unlisted subsidiary. Again, I am using the word unlisted over here, not the material. So I'm still not talking about the materiality. Okay. Now some will ask, what is the meaning of significant transaction or arrangement? What do you mean by significant transaction or arrangement? Significant transaction or arrangement means that transaction, let's say for example, if it's the income transaction related to income or expense, or let's say asset or liability, let's say any of the transaction, if they exceed 10% of that category. Let's say, for example, if this transaction is of income, then if it exceeds 10% of the revenue, total asset, total income, total liability, then it will be your significant one. Then it will be significant. Okay. Now, another criteria for the management is that a listed entity shall not dispose of shares in material subsidiary, result in its reduction of shareholding to less or equal to 50%, or to cease the exercise of control over the subsidiary without passing a special resolution in general meeting. Okay, now what is the scene is, if today if today board of directors decide, okay, this is my material subsidiary, I own a good amount of controlling rights over here, but tomorrow if I want to share some stock in that material of that material subsidiary, and in such a way that after selling out the stock, the holding in that material subsidiary becomes, you can say, less than 50%, or is not that much sufficient that I still hold any control over that material subsidiary, then this is a significant transaction, because I'm losing a control over my material subsidiary. If there is a significant transaction, then that significant transaction should be approved by a special resolution in general meeting, that should not be taken by board directly. That is the main purpose behind this particular transaction. So it talks about sale of share, okay, disposing of share, disposing of shares of material subsidiary. Now again, I'm talking about material subsidiary. Okay, the word unlisted has not been used. I'm only talking about material subsidiary. It can be listed material subsidiary, it can be unlisted material subsidiary, both. I'm just shooting material subsidiary. So unlisted subsidiary, it can be any unlisted subsidiary. Material subsidiary, it can be any material subsidiary, whether listed or not. Material unlisted subsidiary means subsidiary which is not listed but still material. So there are three terms that we are using. So you need to see which term is used where. So I'm talking about, as of now, material subsidiary. Okay. Disposing of share of material subsidiary in case where after disposal holding is less than equal to 50%, less than equal to 50%, or there is a cessation of exercise of control. Cessation of exercise. Cessation of exercise of control. That I'm no longer exercise my control over that particular entity. Okay. Now this should not happen. This should not happen without any approval. Without any approval. For this whole, we need special resolution in general meeting. Without special resolution, this decision cannot be taken by the listed entity. Same way, if we are disposing asset or disposing, selling, and let's say disposing, selling, or leasing assets more than 20%. Okay, more than 20% of the asset of material subsidiary okay, of the 20% of the asset of material subsidiary, okay, aggregate in a financial year, means during that whole financial year, then I require a special resolution by shareholders. Now when I say 20% of the asset, okay, that asset belongs to material subsidiary. Again, not listed, unlisted, both. Listed, unlisted, both are covered. I'm talking about material subsidiary as of now. Okay. So this was regarding the requirement of management or role of management in case of material subsidiary, or you can say unlisted subsidiary, or you can say material unlisted subsidiary. Depends upon case to case basis. What is the scenario we are talking about? Okay. Let's do one thing. Let's take a quick break for 10 minutes. Then we'll join back and we'll continue with this topic, and then we'll see then rest of the things for this particular LODR regulation from the corporate governance point of view. Okay. Let's take a quick 10-minute break. Nisarg ji.
Nisarg.
Thank you. Hello everyone, welcome back. I hope everyone is recharged. Okay, so let's continue and quickly go through this rest of the part for this topic. Okay, we discussed right now about the roles and responsibility of the management of the listed entity with respect to the subsidiary, whether it's a material, it's unlisted, material unlisted, so various type of subsidiaries. Okay. uh, So Jay, see, very good question. So are we required to have two separate vigil mechanisms, like one for the LODR, one for the company effect? Answer is no. Have one single vigil mechanism. Company is required to have one single vigil mechanism, but that should cover the requirements of both LODR plus companies act. Okay. Now we'll quickly discuss about one. Remember, the next part for our discussion is, and I'll let you from our list. We discussed about vigil mechanism, that is done, code of conduct done, disclosures done, management of subsidiary company done. Now audit committee done. Now there is a risk committee. I'll say risk committee plus there is one more committee that we need to see, that is nomination committee. Okay, nomination committee and risk committee, related party disclosures, and compliance certificate by CE CFO. Okay, let's quickly go through these things. First, I'll discuss about risk committee, nomination committee. Nomination and remuneration committee. Regulation 19 and Part D of Schedule 2. Now you will be wondering why we are reading this, why we are studying about this committee. See, to understand the corporate governance, you need to understand, okay, what are the best practices that can be implemented in the company, and these best practices are converted into the form of regulations, and issued by the SEBI. When we certify the conditions, compliance with the conditions of corporate governance, we need to certify whether these regulations, wherein, let's say, for example, mandatory nomination and remuneration committee. So whether the company has formed a mandatory nomination and remuneration committee, whether the company complied with the regulations of 19, like composition of this committee, like those all things that we are going to discuss now. So once you certify whether the conditions of corporate governance are complied or not, for that you need to go through all these things, whether these things are complied with or not, whether these regulations are complied with or not. Okay, now as per the regulation 19, board of directors of listed public company, okay, shall constitute the nomination and remuneration company, that is there. Now which shall comprise of at least 3 directors, all of whom shall be non-executive director, and half at least should be independent directors. So the committee should have at least 3 directors, and these 3 directors all should be non-executive director plus half of committee should be of independent director. Okay, means all should be non-executive plus half should be independent directors. That should be the composition we are talking about over here. Composition of committee. Now, this was when the company is not having any SR. If company is having SR, means special right equity shares, then the half will become 2/3 in case of SR. Okay, 1/2 will become 2/3 in case of SR. Okay, now a chairperson of the listed entity of the company, whether executive or non-executive, may be appointed as a member of remuneration committee, but shall not be a chairperson. So here, special requirement: chairperson should not be chairperson of the company also. Like it should be separate. So chairperson of BOD should not be the chairperson of this committee. Chairperson of BOD should not be chairperson of this committee. Both should be different. He can be a member, chairperson of BOD can be a member, but it cannot be a chairperson. Okay. Now, quorum for this committee, quorum for the nomination and remuneration committee, simple. Quorum is very much simple. Either 2 members or 1/3, either 2 members or 1/3 of members, whichever is greater or higher, should be my quorum. Simple. And they should meeting at least once in a year. Only once in a year. That's it. Not further required. Now we understood meeting, composition, the nomination of the who should be part of the committee. Okay, quorum, understood. Now, what is the role of committee? What committee does? For the sake of name, I cannot form a committee. Like, okay, today let's say form another committee, like risk management committee. Tomorrow I'll say no, let's make one more committee, finance management committee. But there should be roles and responsibilities assigned to these committees. Okay. So what is the roles and responsibility of this committee? So roles. So first role is formulation of criteria for determining qualification of BOD. Okay. My first role is formulation of criteria for determining what? Qualifications positive attitude okay, qualifications, positive attitude, then independence, then remuneration of directors and key managerial personals. So first, formulation of criteria for determining qualifications, positive attitude, independence, evaluation of directors and key MC. That is the first role that the committee is required to follow. Okay. Then again, formulation of criteria for determining performance of independent directors. That whether independent director are performing well or not. Okay. Advising board on diversity. On advising board on diversity, or devising a policy on diversity within the board. You can say devising policy on board diversity. Then whether to identify a person who are qualified to become directors. Okay, so that is formulation of criteria plus identification of directors. Now, when I say identification of the directors, like from senior management, let's say the person is VP or senior manager, key manager, personnel, but he's not yet director. Okay, so identification of directors from senior management who are qualified enough to become a director and to recommend them to BOD. So these are some certain roles for the committee that committee needs to perform. Okay. So this was about the nomination and remuneration committee. Second, another committee that I'm going to talk about is stakeholder relationship committee. These are some mandatory committees that are required. Okay. As per the SEBI LODR regulation for a listed entity. Regulation 20 and Part D of Schedule 2. Okay. Like what is the role should be for this committee? The role for this committee should be like looking into various aspects of interest of shareholders, debenture holders, okay, various aspects of interest of shareholders, debenture holders, and other security holders. Okay, so the role of this committee is to look into the interest and think about the interest of these people, like shareholders, security holders, you can say then debenture holders. Now, for example, how they will look into the security, like for it may happen, okay, that debentures are secured for certain asset. Now, if any of the decision is taken on that particular asset, then we need to think about the interest of the debentures also, debenture holders also. Okay. So that's the main purpose of this committee. Second thing is, chairperson shall be non-executive director. Should be non-executive director. Then again, composition, at least three. At least three directors as a part of the committee, one being independent. Okay. One being independent. Okay. Now, when a company is having outstanding SR equity shares, okay, if the SR equity share is present, if SR equity shares, then one being independent will become at least 2/3 will become independent. 2/3 shall be independent. Okay. They should meet once a year. Now, roles: resolving grievance of the security holders, review of measures taken for exercise of voting right by shareholder, review of adherence to service standards, review of various measures and initiatives taken by a listed entity for reducing quantum of unclaimed dividends. So there are some roles given. I suggest you read in detail, but these are certain roles which are in line with this purpose that we discussed for this particular committee. Okay. Then the next committee that we are going to discuss is a risk management committee. Now, each of these committee have some specific purpose, some specific role. That's why they are constituted. Okay. And they are necessary for the corporate governance, good corporate governance, basically. Regulation 21. Again, same. Minimum 3 members, majority of them being, minimum 3 members. Okay. One should be independent. One should be independent director. Okay. Now, if SR equity shares, then what will happen? Then instead of one, it will become 2/3 independent directors out of minimum 3. Okay. Then shall meet twice a year. Till now, remuneration committee, then stakeholder committee once a year. This will become twice a year because it's about the risk. Okay. Quorum, again, either it should be 2 members or 1/3. 2 members or 1/3 member. However, at least one board of directors should be there. Means one director should be there, whichever is higher. Now, why I'm saying one director? Reason because initially I wrote 3 members. These members can be directive, can be other KMPs. Okay. Now, when I say quorum, 2 members or 1/3 member, at least one of them should be director. Till now, we were talking about an independent director, but here the condition is only director from BOD. Okay. Now, when I say twice a year, between 2 meetings, there should not be more than 180 days period. So gap should not be less than or should be 180 days between 2 meetings. Okay, now roles and responsibilities. The roles and responsibilities should cover related to risk management. Now this should be risk management plus cyber security. This is a newly added thing to the roles and responsibility of the risk management committee. Okay, so now the cyber security will also be part of the risk management committee. Risk management company needs to plan risk management policies or some actions on the cyber security also. Cybersecurity is a growing field. It's it is very important for each and every company. As in when we are moving to the digital age, cybersecurity becomes very much important because data. If there is a integrity issue with the data, then there will be a lot of issues within the company. If you don't have a appropriate data which is where the integrity is not compromised, then only you can perform any of the activity, any of the audit or any of the review. If there is an integrity issue with the data, then how can you rely upon the data? That's why cybersecurity is something very much important piece in current scenario. Detailed what you can say roles are covered in part D of schedule 2. Detailed roles, and not go into the detailed roles, but detailed roles are covered over there. Now, is this applicable to each and every one? Answer is no. This is applicable to top 1,000 companies. So it is only applicable to top 1,000 companies, not more than that. Based on, when I say top 1,000, based on market capitalization. Okay. So this was the requirement for risk management committee. Then okay. Then we'll talk about very important topic, is the compliance certificate. By CEO, CFO, okay, that is covered under regulation, sorry, not regulation, part B of schedule 2. Okay, compliance certificate. Now under this compliance certificate, what is required to be done is CEO or CFO, CEO or CFO has to certify okay, that they have reviewed financial statement, cash flow statement, okay, and to the best of their knowledge, these statements do not contain any materially untrue fact. Okay, they do not contain any material untrue statement or facts or information. Okay, these statements present a true and fair view of listed entities affairs. Present a true and fair view. Third, these statements comply with accounting standards applicable, laws and regulations. Okay, so review financial statement and cash flow statement, and they do not contain any material untrue information. They present a true and fair view, and they comply with the accounting standard and applicable laws and regulations. Also, they are required to provide that no transaction entered by the listed entity during the year which is fraudulent, illegal, or violation. So, no fraudulent, illegal, or violative transaction entered during the year. Okay. Then they accept responsibility of establishing, maintaining internal control. Accepting responsibility of maintaining internal control for financial reporting. Okay, and their effectiveness and all those stuff. Plus, they have indicated to auditors and indicated to auditors and audit committee significant changes significant changes. Okay. And significant changes with respect to my internal control over financial reporting, my accounting policy, and I have indicated any fraud that has occurred. Okay. So this was a certificate that CEO, CFO has to sign and provide as per the Part B of Schedule 2. Any doubt till now? Any doubt? Good question there. Whether risk management committee is linked to SA 315, 330, they both are different. Reason because risk management committee is committee formed by the company, listed entity, and they are governed as per the regulation. Now, when I say SA 315, 330, it is applicable to auditors, and that is for assessing the risk in the case of an audit and assess respond to the risk identified. Okay, so they are from the SA are from the audit point of view, but when I say risk management committee, it's another story where the committee is formed by the company to look after some of the duties which are mentioned in the regulation. So both are different. Vijula, can you just read, can you explain a bit more in your question? ICFCR means internal. So ICFCR stands for Internal Financial Control over Financial Reporting. So I'll return just a minute. It should be ICFR. Internal Control over Financial Reporting. Internal Control over Financial Reporting. Okay. Thank you, Jay, for highlighting this change. Good question. Compliance certificate by CACS or by CECFO? Both. So a certificate that is issued by CA is whether the conditions of the compliance, whether the conditions of the corporate governance are complied with or not. It includes one of the condition where the CECFO has to sign this certificate. Okay. So first will come CE and CFO certificate. Then it will come a certificate by CACS wherein they will verify whether all the conditions or corporate governance had been complied with or not as per the regulations. Vijula, if the conditions are not complied with, so for example, let's say one of the condition which is, let's say, whether the financial statement are presenting true and fair value. If they are not presenting, then there is I think there is not a point of issuing the certificate. Rather than it will, the management has to rectify the financial statement so that they can present a true and fair view. So if there is anything negative, then the management needs to act and rectify that thing rather than providing a negative comment in this certificate. Okay, guys. Okay. Now, next part for the corporate governance is related party transaction disclosure. Okay. Now, as per this particular related party transaction disclosure, okay, uh, like requirements of Companies Act, requirements of accounting standard are by default required to be complied with. Okay. So this is not a substitution of the requirement which is given under the Companies Act or accounting standard or Ind AS. Remember, these disclosure requirements are over and above those disclosure requirements. So in this case, company is required to submit a quarterly compliance report. First of all, quarterly compliance report. Okay. Now compliance report on corporate governance in the form that is specified by the board. So first of all, you submit compliance report on corporate governance, quarterly compliance report to the recognized stock exchange, to stock exchange within 21 days from the end of each quarter, within 21 days from end of each quarter. Okay. Now you will ask, okay, if they are required to submit the compliance report, quarterly compliance report on corporate governance, then what is it is to have to do with the related party transaction? Now, why we are looking in related party transaction, a quarterly compliance report? Reason, because this particular report should contain details of all material related party transactions. This report should contain details of all material related party transaction. Now, when I say material, what is material over here? Material means the list transactions with any person, entity, either he's from a promoter or promoter group, or you can say he's a related party. So transactions with the related parties which are material in nature, okay, are required to be disclosed over here. And so for each and every type of transaction, there is a different materiality limit. So you need to see regulations for materiality, because at times, not only in the numbers, but that at times you need to see the essence of the transaction, whether it's a material or not. For example, let's say maybe a transaction which is not material, but it is with the entity or subsidiary which is a sick unit, or you can say entity which is on the verge of insolvency. That you need to depend upon whether it's a material or not, based on criteria and condition given in each and every scenario. Okay. Okay. Now, related party means transactions with any person who is a related party as per the definitions of the Companies Act, plus entity belonging to promoter group or any person who is holding 10% or more of shareholding in the listed entity. So you need to see who is a related party with the total of, the definition of the related party given under the regulations and the Companies Act. Now this is required to be submitted within 30 days, within 21 days from the end of each quarter, that compliance report. Plus, over and above this, a listed entity, now over and above this, listed entity is required to submit within 30 days of this consolidated financial result for half year. Okay, disclosures of related party transaction on consolidated basis. So from 30 days of publishing of consolidated or standalone financial statement, standalone or consolidated financial statement within 30 days from publishing of standalone or consolidated financial statement for half year, not quarterly but half year. For half year, a disclosure is required to be given of related party transaction on a consolidated basis. In specified format, the format is specified, okay, to the stock exchange. So there are two requirements: one with quarterly compliance report, second a separate disclosure half yearly. So two disclosure requirements for related party transaction. Okay, so that was the disclosure requirement for the related party transaction. Any doubt? Any doubt, guys? Any doubt? No? Okay, let me take up one question. Okay, just a quick question on one of the area, and then we can move forward. So this will give you a flavor of, okay, how the things are asked in the exam also. Plus this will also enhance your understanding of the topic. Okay. ABC Limited, ABC Limited listed entity was having 4 subsidiaries. Okay, A, B, C, D. Okay, and ABC Limited, and a consolidated dated figures. So first income 10, 5, 50, 5, 30, 100. Then net worth, let's say 100, 50, then 200, again 50, This will be 300, 700. Okay. Now this is the arrangement as of now for ABC Limited, who is having 4 subsidiaries plus ABC Limited and the consolidated figures. Good. Okay, now as per the provisions, okay, ABC Limited, what ABC Limited did is ABC Limited appointed Mr. D, who is non-executive director of ABC Limited on board of C Limited. Okay. Now Mr. D has appointed ABC Limited has appointed Mr. D, who is a non-executive director of ABC Limited on board of C Limited. Okay. Then second, C Limited. This was the first point. Second, C Limited submitted annually board meeting minutes. Sorry, did not submit it. Sorry, did not submit it annually board meeting minutes to ABC Limited's board. Okay. Then during the year, C Limited, okay, C Limited incurred a transaction or entered into an arrangement, entered into sales contract of rupees, you can say of rupees. These numbers I am talking about over here are in rupees CR. Entered into a contract of rupees 20 CR. Okay. This information was not provided to ABC Limited as it was not mandatory. Now you tell me, then 4. Okay, let's keep this much only. You tell me now, what are the issues you see in the current case? What are the issues that you see in this particular that C Limited or ABC Limited has done inappropriately, where they have non-complied with the regulations? So you tell me where they have non-complied with the regulation. Pretty easy, nothing difficult. Pretty easy, no difficult, nothing difficult over here. Come on, guys. Come on, guys. Come on, guys. Come on. Okay, correct, Jay. Correct. Come on, guys. Pretty much easy. And you need to provide why, on what reason that you are giving that answer. Like, for example, if you are saying this is required to be done, then why? Correct, Jay? Come on, guys. Pretty much easy. Come on. I'm waiting for your answers. Also to add upon over here, okay, also to add upon, let's say there is a Mr. D. We are talking about, remember ABC Limited appointed Mr. D on, who is the non-executive director of ABC Limited on the board of C Limited. Now let's say Mr. D is also on the audit committee of A Limited. Also on the audit committee of A Limited, ABC Limited. He is the chairperson, sorry, of the audit committee of A Limited, audit committee of ABC Limited, risk management committee of B Limited, risk management committee of C Limited, stakeholder interest committee of ABC Limited, and stakeholder interest committee of B Limited. He is the chairperson of these following committees. Also to add upon the current question, I have added this additional information. You need to provide where is the non-compliance and why. Come on, guys. Where is the non-compliance that we are seeing and why? Based on what thing? Okay. So in the current scenario, first of all, ABC Limited appointed Mr. D, who is a non-executive director. Okay. But as per the provisions, as per the regulations, as per the rules, ABC Limited is required to appoint an independent director instead of a non-executive director. Okay. So we discussed just before that, okay, as per the roles and responsibility in the case of subsidiary, okay, at least one independent director on the board of directors of unlisted material subsidiary shall be there from the board of directors of ABC Limited. So there should be independent, not a non-executive director. There was a first non-compliance. Second, C Limited did not submit annual board meeting minutes to ABC Limited. So that was a non-compliance, because minutes of the board meeting of all the unlisted subsidiaries shall be placed at the board meetings of listed entity. During the year, C Limited entered into sales contract of 20 CR. Okay. This information was not provided to ABC Limited. Now, all unlisted subsidiaries, not only material but unlisted subsidiaries, are required to provide details of transactions of significant transactions and arrangement. So this is significant because total income of C Limited 20 CR, 200 CR, 50 CR, and we are talking about 20 CR income over here. So this is material, and from that point of view, this transaction was required to be submitted to details of this transaction was required to be submitted to ABC Limited, which was not given. So these were the three things. Correct, Vidyula? Absolutely correct. Now, with respect to Mr. D, we know that there is a ceiling on committee membership and chairpersonship. Okay, as per that ceiling, a director can become or act as a chairperson of more than cannot act as a chairperson of more than 5 committees. He cannot act as a chairperson of more than 5 committees. Now we are seeing 5 committees over here: audit committee of ABC, risk management committee B, C, stakeholder committee of ABC and B Limited. Total 6 committees. Now here he cannot be a chairperson of more than 5. This will again become a non-compliance. So like this way, questions can come in exam, but these are the pretty much easy one. I can formulate a assignment for you guys. I can try to formulate an assignment for you guys, and we'll try to submit today so that you can practice on based on those MCQs for this particular topic, and it will enhance your clarity. So generally, these regulation-based questions can be asked in exam. Not necessarily this way. There can be a multiple type of, but the point is, if you have the clarity of the provision, if you have the clarity why these things are there, then I don't think so there will be an issue to answer any of the question. Okay. So that's it from this particular topic, audit committee and corporate governance. Any doubt, guys? Any doubt? Okay. Now, guys, the next topic is consolidated financial statement. Okay. Now, with respect to the consolidated financial statement, what I'm going to do is there are 2 things that I'm going to discuss. One, the reporting format. Okay, what is the reporting format over here for the consolidated financial statement? Number 2, I'm going to discuss like detailed provisions which are related to the consolidated financial statement. Okay. Now, for example, what are the roles and responsibilities from the company's point of view? What are the roles and responsibilities, why like of the company under Companies Act? So I'm going to discuss all these scenarios, all these details. Who are required to prepare a consolidated financial statement, who are not required to prepare a consolidated financial statement. Okay, so these things I will be discussing with respect to the consolidated financial statement. I hope you guys have already read this topic, but if not, no worries. I'll explain in the details. The audit considerations, how to audit a consolidated financial statement, what are the things you need to take care while auditing this particular area. Reason because if you understand the provision, if you understand the details applicable to this particular thing, then only you will be able to answer able to understand how to audit these areas. Okay, just give me a minute. Let me start. Okay, so as per the let me start a new book, new page. Okay, first of all, we'll try to understand from where the provisions fall. Okay, from where these provisions are coming, on what basis the company is required to prepare a consolidated financial statement. So it starts from section 129, okay, of the Companies Act. As per section 129 of the Companies Act, it is a responsibility of the company to prepare the financial statement, and where the company has one or more subsidiaries, as per the section 129(3), including associate company or joint venture, it shall prepare, in addition to its own financial statement, a consolidated financial statement. So section 129(3), it says that when a company has, if a company has subsidiary plus joint venture or associate, okay, then in addition to its own financial statement, the company shall prepare CFS. Simple. 129(3). Then it comes about section 129 subsection 4, okay, that talks about that the provisions which are applicable for the preparation and presentation of standalone financial statement will also apply to the consolidated financial statement. So let's say, for example, if the company is preparing their standalone financial statement based on applicable accounting standard or Ind AS, then the same will apply to the consolidated financial statement. So all the provisions which are related to the standalone financial statement will be applicable to the consolidated financial statement also. Okay. Now, again, as per the requirements of this section 129, these statements are also required to be signed by board. Not only the standalone financial statement, but consolidated financial statement are also required to be signed by the board. There is one more requirement which talks about that a separate statement containing the salient features of the financial statement of subsidiaries is required to be filed in form AOC1. Means form AOC1 is required to be filed, okay, by the company, which contains silent features of its subsidiaries. Okay, silent features of its subsidiaries financial statement. Now this is the form AOC1 which is required to be filed. Okay. Again, so there is a format given in schedule 3 that we will see for the preparation of the consolidated financial statement. That is not that much different from the division 1, division 2. At the end of every division, let's say division 1, division 2, there is a part C which talks about the consolidated financial statement, which provides some additional information over and above the part 1, part 2 information which is given in division 1 and division 2. That we'll see in a while. Okay, so this is from the company sec point of view, a bit of detail. However, this consolidation of financial statement, when preparing consolidation financial statement, is not applicable in 3 cases. Is not applicable in 3 cases. One, when the holding company is an intermediary company, means you can say there is some more company, there is one more company who is the ultimate holding company, and that company is preparing consolidated financial statement and filing the consolidated financial statement with registrar, which are in compliance with applicable accounting standard. So I'll write it down. Exceptions for CFS, like when CFS are not required to be prepared. One, when ultimate or any intermediate holding company ultimate or intermediate holding company, okay, files CFS with registrar, which are as per applicable accounting standards. Okay, number 1, first exception. Second exception, company, it is a company whose securities are not listed or are not in process of listing of any of the stock exchange within India or outside India. So the requirement relating to the preparation of consolidated financial statement shall not apply if the company whose securities not in process of listing. Okay, plus and the third condition, okay, it is intimated to all members, okay, who are entitled to vote or who are not entitled to vote, and in writing is available, in writing it is provided to them that they will not be presenting the consolidated, intimated to all members that CFS will not be prepared. Okay, so if all of these conditions are satisfied, if all 3 conditions are satisfied, then the exception is there and company is not required to prepare consolidated financial statement. First, there is ultimate holding company who is preparing a financial statement and filing with registrar. Second, company is not in process of listing or is not listed. Third, it is intimated to all members that the CFS will not be prepared. If all these 3 conditions are satisfied, then there will be an exception from the CFS given. Otherwise, it will not be given. Clear? Another area where the exception is given is investment company. So central government has also notified certain classes of companies which are exempt from complying the requirements of CFS. Okay. Now, one of them is an investment company. If it is an investment company, Okay. Investment companies are not required to present consolidated financial statement as per Ind AS 1110 to measure its all its, and they are required to measure all of its subsidiary at the fair value through profit and loss account. Okay. Now there are conditions given for the investment companies. What is an investment company? You need to refer to that particular definition for the investment company. So investment companies are basically exempt. Okay. However, there are also certain conditions given in Ind AS 1110 where a parent of investment company can prepare consolidated financial statement, although provided the parent is not also an investment company. So there is an conditions are also given in Ind AS 10. So investment companies are exempt as of now. Okay. So these are the requirements of preparation of a consolidated financial statement. Okay. Now, what is the responsibility of a parent company to prepare a consolidated financial statement? Let's say I know today I need to prepare a consolidated financial statement. What I'm required to do for that? Simple. What I'm required to do to prepare a consolidated financial statement? What is role of parent company with respect to consolidated financial statement? What I'm required to do? Pretty simple. There is a step-by-step approach. If you follow, it's very simple. First, identify components to consolidate. Which all companies you will consolidate? Whether it's a subsidiary, it's a joint venture, it's an associate. How you need to consolidate? To identify the components first of all. Okay. Then identify segments. If the segment reporting is applicable, then identify the segments. Identify related parties. Okay. Related parties are also required to be identified because you need to report related party transaction. Then obtain information from these. Obtain information from components regarding their segments, regarding their related parties. So obtain information. Once you identify it, then obtain information. Once you obtain information, then perform adjustment. Now adjustment can be your what you can say permanent adjustment, one-time adjustment. Those are temporary adjustment. So perform adjustment. Then harmonization of accounting framework. Very important. Let's say, for example, one of your subsidiary is listed in, let's say, for France, is a European subsidiary. Now they will prepare financial statement as per the European GAAP also. Let's say, for example, something related to the IFRS, but in a different format. There is a local GAAP applicable. So they have presented the financial statement, prepared the financial statement in local GAAP. They have a different accounting policies over there. They have provided all the information. Now, for the purpose of consolidation, you need to adjust their accounting framework, and you need to convert that into your accounting framework as per the applicable Indian accounting standards or Indian laws and regulations. So you need to harmonize the accounting framework wherever there is a difference. Plus, you need to perform gap conversion. Okay. You need to perform gap conversion. So this is you need to perform and you need to do while preparing the CFS. These are the roles and responsibilities for parent company for preparation of consolidated financial statement. Any doubt? Any doubt? Sairam, can you re-ask your question because I'm a bit not clear. Acha, you want to understand the logic of consolidated financial statement. Okay. So why this provision is there? Simple. Now, for example, you have a 10 companies. Okay, I can see, okay, when I'm investing, let's say, for example, in Reliance, I know Reliance has invested in multiple companies. Let's say, for example, XYZ company. XYZ company has invested in XYZ. To identify what is the real net worth of that particular XYZ Limited. So, for example, today I have invested 1,000 rupees in X Limited. XYZ Limited has invested 1,000 rupees in X Limited. But my balance sheet will only show, okay, 1,000 from the investment side. But what if, but what if the 1,000 rupees, what income that 1,000 rupees had earned? What expenses that 1,000 rupees, behind that 1,000 rupees, the company has expended? Or you can say, what is the asset of that in front of that 1,000? Or as a whole group of XYZ Limited, what is the position of XYZ Limited as a group? Because from a standalone point of view, it may happen that, okay, standalone entity is not sufficient only. One example, let's say, simple example, car manufacturing company. In a car manufacturing company, one company prepares the outer of the car, outer areas of the car, let's say doors, frames, chassis, and everything stuff. Second company manufactures the tire. Third company manufactures the battery. And fourth company performs the assembly of all the things from that one company 1, 2, 3 purchases. Now, if you see the standalone result of assembly company, you will not get an idea whether the income of this group is good or not. If I want to assess the income of the group, I need to assess the income. I need to see the income, the position of all the 4 companies together. For that purpose only, the consolidated financial reporting is required. Jay, it's a ultimate or intermediary company, not a ultimate independent intermediary. Ultimate or either intermediary, some other intermediary company. Any doubt, guys? Any doubt? Guys, it's very important that you read the topic before start of the lecture. Reason because it will enhance your understanding that what we are going to discuss. Number 2, you will be able to correlate the things that I'm discussing over here with the things that you have already read. So it will enhance your reading. It will enhance your remembering things, understanding the things, and you will be able to answer the questions very easily. Also, please provide the feedback on mobile app or on the portal. It is very important to us to understand what are the things that you are liking or what are the things you need further. I've seen some feedback today also. I'll try to provide those things as fast as possible. But make sure that you read it, you understand the topic, prepare the notes, so that it will be easy for you to remember and revise at the time of exam. Okay. Yeah. Jay, so you are asking example of ultimate or intermediary company. No issue. Let me tell you. It's a structure based thing. Let's say, for example, A Limited, B Limited, C Limited, and D Limited. This is unlisted. This is also unlisted. This is listed. This is also listed. Now, B is a subsidiary of A, C is a subsidiary of B, D is a subsidiary of C. B is an intermediary, C is an intermediary, D is a subsidiary, or you can say component. For A is the ultimate holding. Now B and C can get an exemption provided A is preparing their financial statement and in compliance with the laws and regulations of India, and they are, A is submitting the consolidated financial statement, filing the financial statement with the registrar. So A will be the ultimate holding company who will be consolidating B, C, and D. Sorry. Okay. So this is how it will happen. B is a ultimate intermediary holding. This is a pure subsidiary, and A is the ultimate holding. I hope it is clear. Sure, Sayam. Definitely, I'll do that. Any further doubt, guys? Any further doubt? Any further doubt, guys? Okay. No. Then let's we end this session here, and in the next session I'll request you to guys to read the consolidated financial statement, audit of consolidated financial statement, and be ready with the questions if you have any, and I will be explaining the detailed provision with the schedule 3. Okay. Thank you, guys. Thank you for the feedback. Thank you for participating in today's lecture, and have a nice day ahead.